Welcome to PZFX Institutional Order Flow. Now, this is going to be part one of PZFX trading model. And today we're going to go over market structure. Now, I'm just going to jump right into it. Now, market structure is by far one of the most difficult parts of trading. This is something that is going to take time to fully understand and learn. It's going to come from experience. And see, where most people get confused is incorporating the different time frames, specifically when doing what we call a top-down analysis. Now, the more time you put in on the charts, the easier this will become, no doubt. But I always say that market structure is king. Market structure is a key component in determining if you're going to be a buyer or a seller in the market. See, these candles symbolizes price over here on the right, price action. This down here on the bottom symbolizes time. So you put time and price together and you have price action. Now, price action has cycles and it consists of different stages. And I'm going to have another video about price action and the different stages. Them stages are accumulation, manipulation, and distribution. Now, today, I'm going to go over market structure and I'm going to break it down in the simplest terms, really like market structure for dummies, if you will. So first, I'm going to switch to a line chart and we're going to start down here at the bottom. You see you have equal lows and equal highs. What this is accumulation, where price is just moving sideways and it's not really going anywhere. Okay, this is the accumulation phase, and this is where the banks accumulate orders. They accumulate long orders, which is buy orders, and it generates sell side liquidity, which is where buyers jump in the market and place their stop losses down here where this line is. So this would definitely get visited in the future. But for right now, let's see, as we can see, the market is pretty much predetermined to go higher. And as you can see right here, we have a low here, a high here. It pushes down, creating a lower low. I'm sorry, a higher low. This is your low. This is your high. This is your lower low. Okay, it creates a high here, a low here. High, low, high, low, low, high, low. You get it, right? Okay, so hold on one moment. As you can see, price is not just shooting up. It's not just going straight up. It's happening in waves and it's forming structure. This is your structure, the low, the high, what I just showed you. This is what we refer to as a bullish market. And this can help us focus on key points for trade opportunities. It's giving us our general bias, which is bullish. So we will be looking for buys in a market that is giving us a high, a low, a high, a low, a high, a low, right? Okay, now when you have a market, now this is on a daily time frame. So you have your low, high, low, high. Now, originally we would be focusing on this low right here, and there would be an order block, a daily order block in this area, right? And we would want to see something like this, like our order block would be somewhere up in here, right here on this price swing, but we're focusing on this price swing here. Okay, it goes up and it happens in waves, right? Like I said, it don't just shoot straight up. It's gonna do this. So you want to wait on, you have the expansion and then you want to wait on the retracement back down into an order block. Now, when you have price blow straight through this low here, that's what we call a break of structure, BOS, a break of structure. It's changing your bias from bullish to bearish, from looking for buys to looking for sales, because this low has been taken out and it's breaking the bullish structure. So are you going to buy? I mean, are you going to sell as soon as it takes out this low? No. What you want to do is wait on price to pull back up. And this area here is going to turn into a bearish breaker. So it's going to, at first, we would be looking for a bullish order block, which is the last down candle before this up move. And when price returns back into it, we would be looking for a reaction here to take us back up and target this high. Okay. Now, if this bullish order block gets ran through, it's going to turn into a bearish breaker, aka a rejection block, and you would be looking to sell here. So over here, we can see an example of a bullish order block that has been broken, which would turn into a bearish breaker. Okay, so once we see price break this low and go through this bullish order block, we want to see it roll over and come up into at least 50% of the bearish breaker. Okay, so that bullish order block would be a sell signal, a rejection block. And if we come over here, we can see a perfect example of that. So clearly you have a bullish trending market here. When it breaks down, okay, taking out this low, it rolls over and comes straight back up into this. Now, on this line chart, it only shows the closing price. Now, if I was to switch into a candle chart, we would see price comes up into it with a wick. So this would be our breaker right there. So price breaks structure, comes back up into the breaker. Now, there's a couple different areas that we would want to pay attention to right here. Now, it is the opening of this rejection block or the 50%. Now, in order to measure, you want to measure the body of the candle, not the whole candle, not the wick. So you would get Fibonacci tool and just measure the volume, which is just the body of the candle. And I have a template saved right here, the 50% tool, where it only shows this. Now, in this example, it did not, but later on, you see, as it made this low and retraced, it came up here close to the 50. Now, in a trending market, like I said before, it's always going to come in waves. Now, it's not just going to be a straight up movement. You're going to have a expansion and a retracement, expansion and a retracement. For example, expansion, retracement, expansion, retracement. Okay, so in order to measure these expansions and retracements, let's flip back to a line chart. You can see, like, we can start from here to here. Now this is our kill zone, the green, the 62% retracement level, to the sweet spot, the 70.5 retracement level. Now this whole area is considered the kill zone, but these two spots are my favorite because it tends to react the most off of these two spots. Now, if you flip back to a candle chart, you can clearly see. Now, when you want to measure it, if you put your Fibonacci tool at the bodies, that is measuring the volume, the bulk of the volume of your range, your trading range. See, the wicks are here, but when you switch to a line chart, they disappear because the wicks are just, you know, a little manipulation in the market. But either way, you're going to still get about the same measurement. As you can see, we have price breaking structure, and that would be an entry there. We have price breaking down again. So you would put your Fibonacci tool on your swing high and your swing low. Now, what is a swing high and a swing low? Okay, a swing high is where you have a high with two lows on either side of it. That is your swing high. A swing low is where you have a low with two highs on either side of it. So it would look something like this. Oops. Okay. That'll work. Okay. That is a swing low. Take this down. Ooh, whoa. Don't know what happened right there, guys. Sorry. That's a swing low. That's a swing high. Okay. So once you see price come down and break structure, it's turning into a bear market where we will be looking for sales instead of buys. Because like I said, it broke structure there, it broke structure there. And when it came down here, it created equal lows, which generated sell side liquidity. Now, we have a video in the making about liquidity and other things of that nature. So I don't want to touch into that right now. I'm just trying to stay on market structure. It's kind of hard because all of it coincides together. But I'm also going to have a video to where we're going to add every aspect of trading and put it into one video, kind of like putting it all together video. All right, back to the candles. So once we have that break of structure, we have a swing high here clearly. Okay, break of structure. We want to get a retest after the expansion. You always have phases of a trending market: expansion, retest. This would be considered our expansion, our break of structure. Now, what are we waiting for next? A retest into our kill zone. Now, in this example, this is our kill zone here. We also have a bearish order block, and price comes straight up into the mean threshold of this order block, which is the 50%. So when you're on a higher time frame, daily, weekly, monthly, sometimes you will get a reaction off the wick of the order block. This again on my nerves. Sometimes you will get a reaction off the wick of the order block or the opening of the order block. But most of the time, it's going to be the mean threshold here. As you can see, price comes straight up into that and rolls over, taking out these relative equal lows and going down into our TP level, which is a half of a standard deviation. Price reacts off of a bullish order block here and gives us a move up, back up into the kill zone, rolls over, reacts from this order block, takes off, and gives us a retracement from the bigger dealing range. So from this high to this low will give you a retracement back up into the kill zone for that dealing range. Now, I know this probably sounds confusing, but something that I need you to understand is that these waves of price are just bouncing from order block to order block. So we can write right up here for those of you who like to take notes. I highly suggest you get a pen and pad out and take notes. Screenshot what I'm teaching you, go back into your charts and back test. Okay, so bullish order block is down. There you go. And your fib, you always want to place your fib from the swing high to the swing low, or from the swing low to the swing high. Now, here is an example of a bearish market. I'll give you guys a second. I'm deleting this now. So when you have a daily time frame, the structure is going to look. I'm just going to show y'all how you can use a daily time frame structure. You can use that to determine a trading opportunity on a lower time frame, such as the 4-hour. This is your daily structure. Now, your 4-hour structure is going to have waves within your daily structure. So once you see on a 4-hour time frame, okay, so a daily structure, you're going to have your retest from this expansion. Within this retest, you can get down on a 4-hour time frame, and as soon as a key level like this low right here, as soon as it's broken, anticipate the retest and sell it down to this low. And you know, as soon as it takes out this low, it's going to continue its daily expansion up. Now, on a 4-hour, once it takes out this low and comes up, taking out this high, it's going to start retesting. And once it pulls back, that's an opportunity to buy and ride the daily expansion to the higher high. Now, it's going to seem a little bit confusing at first, but I want you to screenshot this, take your notes. I'm going to have cheat sheets in the Discord channel that has a whole cleaner setup. So you want to use the daily and H4 timeframes. For example, if we are bullish on the daily, we can anticipate higher highs and higher lows on both the daily and the H4 timeframe. And you just got to finesse the timeframes and, you know, get in on a pullback. So it would be there. Those are your breaks of structures on a 4-hour. Okay, so for example, on the right, 4-hour, on the left, daily. As you can see, whatever I do on the left is mimicking it on the right. Okay, let me fix this, make it a little darker for the opacity. Okay, low, high. But within this price swing on the daily, you see you have a wave here. So buy signal. Within this expansion up on the 4 hour, you're gonna have a retracement. Okay. Now it takes off super fast right here, but within this expansion up, you might not have a full retracement back down on a 4 hour, but if you jump to a 1 hour, you have an entry here. On a smaller time frame, you're gonna have a specific pattern within this. See, you get your fib and go from the swing low to the swing high. Price is gonna pull back into the kill zone. Entry takes off, blows past all of our TP standard deviation levels, and then some. Hope that made sense to you guys. Now, clear, uptrend, goes up, up. Now, remember the breaker structure on the daily? This is it. We have our equal lows here. Price comes up, takes out equal highs here, shoots down, taking out equal lows. That's giving us our breaker structure. It closed below these significant equal lows. We got a retest coming straight up into the 50% mean threshold of this bearish order block. Breaks down. As soon as it takes out the most recent low, that's when you should be phasing out of your position because it's gonna retrace. So let's see how many trade opportunities we have here. There's one, so we can mark this level. Okay, then we want to measure this price swing. There's another. That's 2 entries that we found there. Now, understand that there's a correlation between the time frames, like from the weekly to the daily, from the daily to the 4 hour, 4 hour to 1 hour, and so on and so forth. So here is another example of a beautiful trade that from looking at it on the daily, you wouldn't be able to decipher what is really going on here because it's literally just 2 candles and it's a doji candle which is signaling a reversal in the market. So of course you have your order block here, price jams down, retraces back up into a lower time frame order block, which I'm sure would be within this wick. We get an automatic reaction, a push down, and a retracement that comes up into this bearish order block. Okay, so after it mitigates that order block, we get an automatic reaction and a push down. Now, within this price range from this high to this low, you have a beautiful trade opportunity on a lower time frame. So this is teaching you the correlation and how you can use a higher time frame area of interest and then finesse the time frames and drop down to lower ones in order to get your entry. So as we can see, we have this bearish order block, this last up candle before the down move. Okay, liquidity, which would be a target where we would be looking to target these equal lows, this previous low here. So we got my target lines, and we would also be looking to target this low. There is liquidity under each one of these lows. Okay, so I'm just going to show you an example. This is the 4 hour time frame now, and we got our area of interest from a daily time frame. So when, let me get rid of this because we know where we're at now. When you have price going up and showing a strong reaction to the downside, completely engulfing our order block, that is a sell signal because it's showing a strong reaction to the downside. Now, what you want to do is get a horizontal line and pay attention to the low of that order block and pay attention to the opening of the order block. Basically, anywhere from the 50% mean threshold of the order block down to the low. So I'm just gonna mark up them 2 levels there. Okay, let me fix my visual order and bring it to the front. Then we can drop down to a 1 hour and look what we have here, a strong move up, also known as a liquidity purge. And when you see something like this happen, now we have certain times of the day that the market tends to rally, okay, in certain times of the week. And I will get into that in later courses. This is just the #1 video for beginner traders who need to understand market structure. Okay, so I'm not going to go into too much detail about certain aspects of trading in this video. Okay, so we have our daily point of interest. We've seen the 4 hour, and now we're down on the 1 hour. Remember, this is our 4 hour order block. These two, this is the 50%, and this is the low of the 4 hour order block. So we want to be looking to set a pending sell limit in one of these areas. And what I like to do is set my stop loss right above the order block. So if you get on 4 hour, You see that was a long wick. Don't ever underestimate these wicks. See, usually you set your stop loss there, right at the high of the order block. But being as we got a long wick right here, it's not smart to underestimate this wick, because look at the 1 hour, you have a huge imbalance. Okay, this is a fair value gap. It's a fair value gap from there, from that low. Let me switch this up a little bit. Put that right and at the top. There's your fair value gap. This gap in price action should be revisited. Okay, so you want to pay attention to things like that. When you have an order block, a strong reaction to go lower, coupled with a fair value gap, that is a beautiful, beautiful setup right here, guys. So now you want to wait. You don't want to start selling down here. You want to anticipate. Most of the time, it's going to be London session. You want to anticipate London session giving you a retest. So we'll go to 2 o'clock in the morning, 2 a.m. to 10 a.m. So this time frame right here is when London session starts. And within this time window here is when we want to be entering our trade. Now, let me lower the opacity and let me send it to the back. All right, so we have our sell limit in place. We have our fair value gap marked up. We have our higher time frame order block marked up. Now, it's always good to set an alarm at your order block, because price could very well come up into the low of that order block and then take off. And if that's the case, you want to market execute your trade here. But like I said, I keep having issues with my headphones. Sorry about that. So let's play this out. Remember, we want to see price give us a retest during London session and be looking to execute our trade around 8 a.m. New York session. Slide this over a little bit to 8 or 9, somewhere around that. Okay, once we get a confirmed low, which is happening right now, you want to measure your price swing from the high to the low. We have your swing high down to your swing low. And look what we got. We have our entry right in the area of the kill zone. See, everything is adding up right now. Everything is adding up. We have an order block, a fair value gap. Price is pulling back to our kill zone, and all of our confirmations are being checked off. We have clear targets down to the downside, a huge, huge imbalance right here. And you will later learn that imbalances like this are like a magnet to the market. And what this stands for is inefficient price delivery. Okay, there we go. We got triggered into the trade at 8 o'clock, New York open. This setup right here is exactly how I love the trade. Now, it hit our kill zone. The time of day adds up perfectly. Remember what I said earlier about time down here, about time and price. It came up and filled in this fair value gap. These fair value gaps literally are magnets to price. Fair value gap equals a magnet. We have our kill zone. Now you see this manipulation going on right here. It doesn't matter. We are in line with market structure. We know that price is showing us willingness to go lower. We found our area of interest on the higher time frame. So that means we can get down on these lower time frames, any lower time frame, doesn't matter. And you are gonna have the same setup, a 5-minute, right? This is a 5-minute. So you take your Fibonacci tool and you measure your price swing from the high to the low. Now let's go back and look at this on a lower time frame. Now you're gonna learn a lot about these sessions here. The white area is Asian session, which typically gives you a consolidation, which is the accumulation phase. You're gonna have your accumulation phase, London session retest. London session typically gives you your low or high of the day. Okay, in this case, London is gonna give us our high of the day, and it's gonna happen right here. You always want to pay attention from about 7:30 to 10:30, and that is gonna be your New York open. Now, remember what I said, I was looking for price to come up and activate my sell limit here. I know it's a large stop loss, but okay, I told you never to underestimate the wick. But if we would have went with our standard rule and placed our stop loss at the high of our order block, maybe a couple pips above it, just to be on the safe side, right? So that's an 8-pip stop loss. We should be okay. We should still be okay, because this higher time frame order block is stopping price. And this fair value gap, that's the only reason price is coming up here, is because of this fair value gap. The higher time frame order block, 50% of the higher time frame order block, okay? And on the lower time frame, you have this rejection block right here, which is bearish breaker. Everything lines up. And that's what you have to learn how to do, is make all of your confirmations line up perfectly. Fair value gap. Okay, you can check them off with me. A fair value gap, a breaker, a higher time frame order block, and the kill zone of the Fibonacci. Now let's watch how beautiful this price action is, okay? I'm gonna maximize the screen. I wanna zoom it out a little bit and play it out. That's your manipulation at New York Open, okay? That's why you always wanna wait until a little bit after New York Open. Like if you would have been on a lower time frame, like the institutional order flow is still there. Like for example, you see this order block here. Okay, here's what we call the London session kill zone right here. Okay, London session opens, drive down, goes up, creates relative equal highs, retest straight down into the kill zone, and then it takes off. Okay, creating another order block here. So if you miss this one, you could get in on this one from this low to this high. I mean, that's a huge high, but it's manipulation. But it don't matter. It still comes down to about the 50%. The 50% of this order block lines up perfectly with the 88.6 retracement level. That's 88% of the retracement. Okay, and it takes off. That would have been a nice little scalp, but we don't want to play around on the smaller time frames. I highly recommend for new traders to remain on the higher time frames. And the only time you should catch yourself on lower time frames is in a situation like this with a higher time frame point of interest. Okay. Now let's watch this price action. Now you recognize what they're doing right now. This is pure manipulation. You have accumulation, and what comes after accumulation? All right, my headphones keep cutting off. I have to get that fixed. Sorry, guys. Okay, where was I? A and B. Right, accumulation, and what comes after accumulation? Manipulation. What comes after manipulation? Distribution. Accumulation, and they're gonna fake you out and drive price up to fake you out to make you think that it's gonna keep going up. Retail traders, 90% of the people who participate in this market are gonna jump in buy positions all on the way up just because of what London session did. Now, London session gave you all this up movement and gave you this manipulation, and they're gonna find some type of indicator or moving average or stochastic oscillators. They're gonna find something to put them in a buy position when us smart money traders are going to be looking to sell right when they're looking to buy. Now, watch how this plays out at New York Open. Triggers us in with an 8 pip stop loss. Okay. Now let's jump back to a higher time frame so we can see what's going on. Now let's clean up some of this. We know we have all this, the kill zone. We understand that. We're going to slide this over. Now look at the amount of down draw that we had. Okay, 3.6 pips. So it don't matter if you had your stop loss up here. It doesn't matter if it was 5 pip stop loss. You wouldn't have got hit. We had it at about 8, I believe. At first, we had it at around 20, 23. Doesn't matter. We only suffered a 3.5 pip down draw. Now watch how our targets are hit. Target 1 smashed. Okay. All of this imbalance right here needs to be filled. Let's play it out. Okay, what do we see right here? We got triggered in and price jammed down tremendously and went straight back up. And why did it do that? It did that because of the imbalance that this candle created. It's jammed down way too fast. It did not allow any buyers to a price to get in the market. And that's why it jammed straight back up. That's why you really don't need to be trying to manage the trade, like set your sell limit or buy limit or market execute and go on about your day. Go on about your day, because if you sit here and watch this, you might see that entry get tested several times and your anxiety is going to kick in and you're going to panic and you're going to close the trade. Or you might get a little bit in profit and close the trade just to come back later on and see that it hit all of your targets. Okay. Another order block was formed here. Price rolled over, tapped it. Price just fluctuates between order blocks, guys. Now we have the end of the day right here. So basically this was our move. Basically this was our move right here for an intraday, but comes right back up the next night to our entry and melts. As soon as it takes out our target, we need to phase out of our position because it's going to start pulling back. It's going to start pulling back, period. Now we can go ahead and speed this up since the trade played out. There's our retest. London session creates the high of the day. London session creates the high of the day here and melts. Now, you want to learn how to catch plays like that? Easy. Very easy, okay? You just got to get in line with institutional order flow. First, you want to do your framework, get your fibs, throw it from the swing high to the swing low, extend that out in time. Okay. What did I say this white area gives you? Asian session. Asian session is going to give you accumulation, and that is price moving sideways. Next, you're going to have your fake out, your manipulation. Okay. Let's jump to a 60-minute chart. We have an order block. It looks very similar to that, doesn't it? History repeats itself in these markets, guys. So you want to take a horizontal line, extend it out in time. You want to keep an eye on London session's price action, which you want London session to give you a retracement back up into your order block. And you want the order block to get struck around New York open, 7:30 to 10:30 a.m. Okay. So here's 7 o'clock. So that's going to be our New York session. We have our higher time frame point of interest here. Can mark up the mean threshold, which is 50% of the order block. And that lines up perfectly with the 0.79% retracement level. We can take this off now, and let's jump down to a smaller time frame. Okay. And on the smaller time frame, what do we have here? A bearish breaker. There's our breaker. What else do we have, guys? We have fair value gap from this low to this high. There's a imbalance in price right here. The breaker, the fair value gap, the order block, all of them are coupled with each other, right next to each other, along with the kill zone. The kill zone is right up in here. Now let's slow this down and play out the price action. Accumulation, price moving sideways, accumulating orders, generating liquidity. Asian session, we have London session underway right now, which is going to give us a retest back up into our area of interest. New York open, there's New York open right there. That's what's going to send price flying. Speed this up a little bit. There it goes. So, like I said, you had the breaker coupled with the fair value gap, coupled with the higher time frame order block. What did price do? What did price do? Hit our kill zone, my sweet spot, 0.70.0.70.5%. Okay. Price comes straight up into that. Price hits the 50% of the breaker, which lines up perfectly with our kill zone. It hit the bottom of the fair value gap. What I tell you guys earlier about the fair value gaps, they make just like a magnet to price. You can guarantee that when you have a fair value gap coupled with the breaker in the order block and the kill zone, you're going to catch moves like this, no doubt. And on that note, we're going to end it. Until next time, good luck and good trading. Take care.